Hello and welcome to Property Summits, where 5 of the country's most experienced property experts come together to unravel the latest developments in the property world and explain what they mean to you. I'm Emma Birchley, and joining me today are Tony Gimple, a man with a direct and no-nonsense approach when delivering advice to buy-to-let landlords, investors and developers, whether that's on tax, accountancy, finance or succession planning. John Howard knows a thing or two about the property business, having bought and sold nearly 4,000 houses, apartments and developments over 4 decades. And we have Nicholas Walwork, who is an experienced investor, developer and property mentor, who makes the most of his expertise in his role as CEO of the world's largest international property forum, providing advice on how to make money through property. Joining me too is Paul Mahoney, best-selling author and serial entrepreneur. He's the founder of Nova Financial Group, providing property investment advice with a particular focus on the buy-to-let sector. And last but most definitely not least is Richard Bush, who turned a personal interest in crowdfunding and peer-to-peer lending into a professional passion, co-founding Crowdlords, which pools resources to enable more people to benefit from investing in property. And first off today, it's tax, and you are the man, Tony, who knows all about that.
I won't say I know all about it, but I know enough not to be dangerous.
Excellent, we'll find out about that now. Now, first off, 130% super deduction on capital allowances. What does that mean?
Basically means if you're running a proper business, typically limited companies, you can claim back 130% of the capital cost of qualifying expenditure, typically plant, machinery, refurb, etc. It's a way of stimulating growth in the economy. It's also not quite what it seems. It's a classic Greek gift. Give with one hand, take with the other. In that, yes, so let's say you've spent £10,000 as an allowable expense for capital expenditure purposes. You've previously paid tax, so you made a profit in the past. You can deduct that now 13,000 from the tax bill or get a refund. It works out, roughly speaking, about 25p in the pound overall. Trouble is, you may get some short-term cash flow benefit. However, by the time you take into account the corporation tax increases, the Chancellor will have clawed that back in the long term. It's also, as they say on the DIY programs, don't do it at home. It is a highly complex area. And unless you're used to doing accounts, working out what can be claimed, how it should be claimed, and over what period, it's a very difficult thing to do for the individual. So you will need specialist advice.
That'll keep you in business then.
Well, it'll keep somebody else in business, but yes, absolutely.
What is the point of it? What's the government hoping to achieve with this?
We've gone through some really difficult times. Brexit, COVID, losing at football, which tends to be national pastime, but nonetheless. And it's a way of stimulating innovation, growth, both in the property sector, technology, so that instead of having to sink a whole load of money into R&D or new plant machinery, refurbishing city centres, staycations for furnished holiday lets, etc., and not be able to claim it back, it's a way of getting businesses to plough money into their businesses, into the economy. So the next time the government has to put its hand in its pocket, state protection racket, that's essentially what it is, and it hasn't changed forever. We've got a stronger economy, more taxes have been paid, they can bail us all out, and we're growing independent trading nation.
Tony, if I may, I've got a question for you. If perhaps someone actually on the panel today is potentially buying a commercial property
None of
and
us do that.
a friend of mine,
Mr. Smith.
Mr. Smith, in an SPV, so a new company buying commercial property, which they're eventually going to convert into residential.
Yes.
What is the chance of Mr. Smith being able to claim back of someone else's expenses, commercial expenses, on that office building before it's then converted to residential? Is there any chance or not?
Assuming they haven't claimed it.
Assuming they haven't claimed it.
Yes, is the short answer.
And how would you get it? Would you get the
You get a rebate.
Would you get it valued? The work that's been done on that building? How does it work?
You need to be able to prove your claim.
Yeah.
The allowance cannot have been claimed before on that property, and you've got to make a profit. You've got to have actually pay tax in order to claim something back.
So you claim it back after you've developed what you're going to develop?
Potentially.
Well, I'm glad I came today now.
But how would you find out if they've claimed back in the past or not?
That
You
will
ask the
be.
vendor normally. CPS ones, is it?
Thank you.
Sorry.
That's all right. No, that's fine. That's okay. You know, I know we want to hear everyone's voices today. Okay, so yes, your accountant will check. It'll be in the legal pack, the conveyance. It's a question you ask on the conveyancing. Have you ever claimed capital allowances?
I mean, it's actually, you know, people watching this show, a lot of people will be looking to buy commercial to convert it into residential. It's a, you know, it's a very, you know...
It's kind of supporting
that
the PD,
example, your
isn't it?
friend is buying the company that owns
No,
the...
I never recommend anyone to buy a company that's already in, you know, in business or been in business a long time, because the due diligence on that company is, I'm sure Tony will say, is horrific. If someone fell down 4 years ago and broke their leg, you could claim next year on it. So no, SPV.
So if you're buying the asset, even still, you can benefit from the allowances.
Because it's on the actual asset itself.
So does this super deduction incentivise developers? Or do you see it as just, you know, you're gaining here but you'll lose over there?
I personally see it as a bonus because I'm not confident enough about it yet, if you get my meaning. But I think as it's proved and more people do it, and as long as Rishi doesn't let us down and then think, well, made a mistake there, I'll change the rules, because
Really? Chancellors do that?
as
No,
chancellors
surely
do
not.
that.
Chancellors change.
Funnily enough,
Chancellors
and they change, they sometimes become prime ministers. Then I think, I don't know about you think, Nicholas, but I think as the time, you know, as the time goes
As it
by,
unfolds and it shows that it is a valid
it becomes more
bonus.
confident. And then you know what's going to happen. You're going to have all these so-called property educators doing courses on it. That'll be the next thing.
What, like we are now, you mean?
But we don't charge for our services.
True.
This is
Absolutely.
all free. I mean,
Absolutely.
As I've heard Tony say many times, you shouldn't let the tax tail wag the investment dog. And I don't think anybody's developing for a deduction. But if you can get it, great.
I think that's good advice, Paul. Yeah, very good.
Because things aren't happening fast, are they? I guess when you're doing deals, they're not always happening rapidly, and things could have changed before you are seeing the benefit.
And developments
anyway.
take time.
Good
as well.
point.
You know, it might take you 2 years, and the deduction might not be available in 2 years.
Yes.
I know it's new, Tony, but do you know if let's say you're buying this asset into an SPV, but you have a profitable company that's the holding company, can that benefit flow up to the profits in the holding company?
That's where you start to get into some really complex areas.
Good thing we got
That's
you,
why
Tony.
we've got you,
That's
Tony.
why we got you here.
So
And
what's
this
the
is all-
answer? What's the answer?
The great thing.
I'll just buy some
This
thinking
is all
time.
free advice. That's the great
Yeah.
thing. Normally he charges. It's great.
Absolutely, yeah. By the letter.
Isn't it? We know
And
that.
everyone else is benefiting. Who's
Exactly.
watching?
Everyone's watching. Yeah.
So, the changes in corporation tax have yet to be fully felt or properly understood. I know we're going to cover that later today. But in principle, if you are a connected person, in essence, you know, you've already got other companies, you will fall into the higher rates of corporation tax. So the whole 130% is just a bit of a lost leader in some ways by government. Can you push stuff up the line? You can only mitigate tax so far. And as Emma said at the beginning, back in 18, whatever it was, you know, the revenue of the day, you know, lost 8.5
It's 8.5 billion between 2018-19 in avoidable mistakes.
avoidable mistakes, or mitigatable mistakes is generally polite phrase. So measure twice, cut once. And as developers, you'll all
Say
understand.
again, measured?
Measure twice, cut once.
It's a tailor's thing.
Right,
Carpenters,
gotcha.
chippies,
Gotcha.
basically. Yeah. So yes, in theory, yeah, you can do well out of capital allowances and other on the surface breaks, but when you start to look at the longer term picture, make sure you've got an advisor who's only selling that which they know and you don't. So they look at the thing in the round. As I'm fond of saying, you need to find out where the bodies are buried and what the likely consequences are, not just today, but going forward.
Cheerful.
I mean, you're obviously talking about
Tax
the
is always very
benefits
cheerful, isn't it?
from your perspectives, but for someone on the other end who's living in one of these properties, actually they could end up with a better place to live because a developer's been incentivised to make the place better, in theory?
I think I think certainly as a developer, I think if you're not up against it, you're not like to cut any corners, and I think some developers will cut corners, sadly, but I like to think the professional ones wouldn't. And of course, if you've got more funds available, then you're likely to put better quality, perhaps furnitures in and things like that, in order to maximise the speed of the sale more than anything else, I'd say.
Okay, well, you mentioned corporation tax there. There are different levels, aren't there, for different amounts of profits. Tell us about that.
Okay, so rather than going into the granular detail, because profits can be calculated in all sorts of ways, there's been a lot of talk about the best way, say, to run a buy-to-let portfolio was via limited companies. The universal panacea to Section 24. However, if you're running a professional and profitable business, you're very soon going to find you're now into the higher rates of corporation tax. And that makes little sense in some ways for the average portfolio landlord to go down the standalone incorporation route. So, we've had 19% corporation tax, going to go up to effectively 25?
That's for profits over quarter of a million. And then for 50,000 and under, it stays at 19. And there's kind of a graduated approach, isn't there, between 50 and 250?
Yes, there is. However, as I said earlier, if you've got more than one business, the rates will effectively be aggregated. So, the
Is that only if those businesses are closely interlinked, though?
If they've got the common directorship,
that's massive, isn't it, Richard?
Massive,
and you imagine you've got 3 or 4 companies, and some of your clients would have who are borrowing money and so on, and they're all connected, and they end up paying 25% tax instead of whatever it is, 24.5 or 5 instead of 19%.
It's significant.
It's significant. It really is.
Yeah.
It's very
not many
serious.
buy-to-let landlords will be making profits at that level. Not unless they've got a large portfolio. Not annual profits. That's a significant.
But Richard, it isn't.
I'd say the majority are probably under 50.
Yeah.
Yeah, but if they're ambitious and they want to get on, they will end up doing that. And the government were talking about getting the corporations tax down to 16% after Brexit, because they know that we need to be competitive across the world. Southern Ireland is 13%, for instance.
But COVID hadn't happened then, I guess, and money needs to be clawed back
But
somehow.
Emma, you could argue that actually you're shooting yourself in the foot, because you want more companies to be based in the UK, and by increasing the tax, what does that do?
Yeah, there's an argument to say that the lower the tax rate, the more revenue you bring in, because the more companies are willing to pay tax.
Yeah. But will anybody here change their strategy because that extra 6% of tax?
Richard, I know you like paying tax, and you've got a very high moral code, but for property developers like me, Nicholas, Paul, we haven't. And well, I'm speaking. Perhaps I'm speaking.
Feel free to stick up for yourselves.
By the way, no one wants to be sat next to me for some reason. But anyway, the point is that it's just not right. We are the entrepreneurs in this country. We are the people employing thousands of people, the small entrepreneurs we all considered small. We employ most of the people in the UK, and it's just not right that they should be pushing it up all the time. I'm hoping fingers crossed, he doesn't know it yet, but I'm hoping that Rushi's going to have dinner with us in October. He doesn't know it yet, but we haven't invited him.
He's going to be the sixth panellist.
He's going to be there's about 20 of us having dinner with him, hopefully. And I should bring this up with him because I'm absolutely furious that the rate's going to go up to 25%.
When's that happening from?
It's
April,
effectively happening from the 21-22 tax year.
Yeah.
Right, okay.
So we as property summits are always talking about treating your property investments as a business.
And being professional.
And being professional and pushing to higher levels.
Yeah.
And this is helping de-incentivise people
without question.
to do that. And it's a shame.
Absolutely.
But I think isn't that what the government are trying to do anyway? Push the smaller landlords out and allow the bigger ones to push in and be able to cope with that.
But not using they're not using the tax to achieve.
No, I think what they're doing on I think that what they're doing on that is they want all people who are investors in property to run a limited company with annual returns. That way because so many people aren't paying tax. They're selling their second, third home. They're not paying any tax. I think eventually they'll make it the responsibility of the solicitor, because now if you make a capital gain, you've got to pay it within 8 weeks, is it, or something crazy?
Effectively.
Yeah, no, it's bonkers. I think they'll make it the responsibility like they do abroad.
Like SDLT as well.
Yeah, to actually,
So
exactly.
it's taken out as part of the deal.
I
you're
think
doing
so.
it.
I think that's what they'll do.
But can I ask a question of
Makes
you
sense.
two then? Because you do large developments. We were talking about some.
Not always.
some of
We're
them.
very happy to do small
You do small
ones.
and large.
Yeah.
Small and large.
Anything that makes good money.
Exactly. You can do far better on a small one than a large one sometimes.
But since the announcement of the change in the tax rate, have you changed how you appraise those projects? Have you changed how you decide whether or not to carry on with the project because of the fact your tax rate is going to be higher based on the profits that you
The
make?
short answer is no. But like John said, if you can get a bit of an extra allowance like these capital allowances,
Sure.
the super allowance, then that
Yeah.
could be a nice bonus that in your SWOT analysis, it's another tick.
And Richard, with that 130% allowance, would you, if you knew it was coming and you were lending money to a developer on that, would you take that into account in your calculations?
No.
Oh, that's nice. Why not? That's a bit harsh, isn't it, Richard?
Well, because it affects the after-tax profits, and
Rather
our
than-
interest is the value of the asset
Gotcha.
and not the profitability of the company.
No, I understand that. I take that back.
That's
the
okay.
developer has to deal with their own tax, so it's not your concern.
Yeah. But there's one key point that everyone misses. You only pay tax if you're making a profit.
Well, it's
So
all
your
right
profits
saying,
might be a bit smaller, but you're still making a profit.
But
it's
still
all
making
right
a profit.
saying that, Tony. But it's all right saying that, Tony. But every time, that it's the entrepreneurs in this country that are getting hammered every time, and it goes on and on and on. At some point, people are going to say, I can't be bothered with it. I've got enough money. I'm going to retire. And all that does is stop more people being, less people then are going to be employed. So it's all right saying that. Oh, you don't make, you made a profit, you've got to pay your tax. Yes, you have got to pay your tax, but for goodness sake, give some of us a break.
I am, as far from being a socialist as it's possible to get.
No, John is.
Well, okay. He's even further.
Don't step on John's toes.
Oh, sorry, old chap. Sorry.
Where's that badge of pride?
Yeah. However, look how much the government has had to put its hands in its pocket just to keep us where we are. And at some point, we all have to contribute to that pot. And there's a lot of talk about social housing, housing shortage, how many properties we've got to build, coping with an ageing population. Well, actually, the bit where I really do agree is that if we had one universal tax rate for everyone, say a flat 20%, or whatever the number happens to be, that most certainly would raise more money. However, we've got the classic two cultures divided by a common language. Earlier on, if like in the warm-up, we were talking about how attitudes in different parts are different. So, back to the 80s and beyond, when
what you're not saying, if you don't mind me, is we're all paying 45% personal tax on top of the corporation tax.
Okay.
And that's what's wrong. 60 odd, 65, 70% tax.
And there lies the rub.
Yeah.
Yeah, because you've got a business, you're paying corporation tax, you're now taking salary,
Yep.
so you're paying income tax, employers' national insurance, employees' national insurance, auto enrolment, all of the costs that go with it. You can run out of your director's loan account very quickly, you can run out of capital allowances very quickly. And if you start to work out, for that successful entrepreneur, whatever the turnover happens to be, if they start to pay too little tax, and technically you could actually end up paying no tax, whether it's morally right or wrong, I'll leave that to everyone else's conscience. You've now got another problem. How do you borrow money as an individual?
But only the super. The problem is that it's the super rich don't pay any tax at all. The poor, the people under a certain level don't pay any tax. It's all lumbered on the rest of us to do it, and that's not right.
Now, let's quickly talk about this new making tax digital. The government really wants making everyone deal with everything digitally. You were talking about the pot and people putting into the pot, but there's not as much in the pot because people are managing to find ways around it. Tell me about this making tax digital.
It does what it says on the tin. Literally, with modern technology, and initially it was aimed at VAT registered businesses. You can take with your device, mobile phone, whatever, photograph your receipt, that will post it to any one of these myriad of bits of accounting software. And you can either, don't do it at home, but do it all yourself, work out your own tax bill and it goes online, or get your advisor to do it. And making tax digital will allow the revenue to, when it wants to, start collecting tax on a monthly basis. Yeah. So no nasty shocks at the end of the year. So literally, pay as you go.
And will you be able to have a better idea of where you're at as you're going along, rather than getting that nasty shock at the end of the year?
You will, however.
There's always a however, isn't there?
Always the
There's
however.
always one of those.
Paying monthly. That's
What about cash flow? What about cash flow?
Yeah.
Yeah.
What if you sell a site? You've got a tax bill next month.
Yeah,
Nightmare.
then you start running into the unforeseen consequences. It's really designed to help smaller VAT registered businesses save money, be more effective, the unforeseen mistakes that the revenue have made, and individuals. Only trouble is, it can have a negative impact. It's real time as opposed to looking back to the previous tax year, which is typically how things work. However, the revenue seem to believe that even though not everybody needs to use it, once they start, they'll find life so much easier. Wow. It's just the way of the world.
But so Tony, it's purely a way of reporting. It's not that it takes them, they'll be able to take the money out of your bank account or anything like that. It's just a way of reporting on an ongoing basis as opposed to at the end of the year. Is it not?
Effectively, yes, but you will be able, if you've got the right...
It's all about having more and more control, surely, Tony, isn't it, really, ultimately?
It's everybody having more control and more visibility of their affairs. If you're doing your own taxes, you can just pay your bill in full with a direct debit.
So will this make a difference to you?
Well,
I think you'll have to really carefully manage your
very
cash flow, won't you?
Yeah, I'm very spoiled.
Big
I don't
sales.
really do much with the financial side. I have someone else do it for me, but I'm sure I'll get a serious talking to about it.
Which your answer will be sorted.
Sort it, yeah.
You're good at what you do, Emma's good at what she does, Paul's good at what he does, etc., etc. Yeah. So you should never ever go to an advisor who is just acting under your instruction.
No, you need genuine advice, and you need to take it. Most of the time.
No point in paying it.
What will it mean for accountants? Because presumably if you've got a smaller business, you could probably deal with this yourself. Does it take money and business away?
No.
You don't think it does?
I don't think it does, because the vast majority of smaller businesses still use professional services. The very large ones tend to have all the expertise embedded.
Thank you, Tony. I'm afraid that's all we have time for today. Join us next time here on Property Summits.